Returns are the key to investment success, period. It's getting the returns that we need. That is what delivers financial independence, financial success, investment success. What determines the return that I get from my investments is probably the most important question that an investor can ask then. But it's one that I think is often overlooked. What determines the returns that I'm going to get from my investments? In this video, I'm going to share the real things that determine the returns that you will get in your investment accounts. It's not picking those stocks that you saw the influencer on YouTube promoting, saying, these 5 stocks are the way to get rich. It's not that at all. These are the things that will drive your investment returns, and the question is, what are they? Okay, let's look at them. The first one is the asset class that you're invested in. It's not about picking those best stocks or those best funds. It's about picking the asset class that's going to go up over the next few months and or years. Valuations and or technical analysis can help predict this with greater probability. One of my favorite investing words, but really hard to say on my videos. Okay, so it might feel impossible to pick the asset class that's going to go up. We've all been encouraged not to do this, to just buy and hold the same asset classes no matter what. That's been drilled into our head. But what if we thought and owned the asset classes that are probably going to go up? How can this possibly be done? Well, the smart money, the institutional money, the money that actually makes money, does this by looking at valuations of assets and by looking at technical analysis and frequently combining, or usually combining those two, in order to make decisions about the asset class that will likely go up next. What happens is we get trapped by recency bias, thinking that what has happened lately will continue to work in the future. Remember, though, that what worked last year may not work this year or next year. We've seen that over and over, but we forget it. We think about what's happened recently. And more importantly, probably, is what worked last decade may not work over the next decade. And when we get decades wrong, a single decade wrong, as many investors actually did in the first decade of the 2000s, and it can certainly happen again, that can destroy our investment success long term. That can make it where we can never recover. Okay, and I'm usually not a negative person, but that can be a big mistake. So we've got to be careful, not get trapped in recency bias, and think, what is going to make my investment returns go up? It's being in the asset classes that are going to go up over the next few months or years. The next thing that drives investment returns are interest rates. What do interest rates have to do with investment returns really? There are 2 major ways that interest rates drive investment returns. First, when interest rates are low, companies are able to borrow money and expand. This helps the stock market go up because companies are able to borrow money cheaply and expand. On the other hand, when interest rates are high, it's hard for companies to grow. This hurts stock market returns. It makes it harder for companies to make money. The second way that interest rates affect investment returns is that when interest rates go up, the value of existing bonds go down and vice versa. Since most investors own stocks and bonds in their portfolios, interest rates will drive their return on their bonds. And we also saw it will affect the returns that they get on stocks. So this is something that truly does affect the return that you get from your investments. And remember, the return we get from our investments is where we want to focus. Okay, so what else determines the returns that you're going to get and that I'm going to get from our investments? That's what this is all about. It isn't about picking fun stocks. It's about the returns we're going to get from our portfolios. It's the actions of the Federal Reserve. That is what determines the results that we're going to get. Why? Well, For one thing, the Federal Reserve determines the interest rates that I explained previously. Also, when the Federal Reserve takes action to put money into the hands of consumers like it did during the shutdown, it stimulates the economy. There's more money to go around. It drives, it fuels profits, and companies make more money, so their stocks go up. The Federal Reserve also increases or decreases bonds on their balance sheet. This affects the overall economy, and it affects investments in various ways. So Federal Reserve actions play a big role in driving investment returns. Their actions indirectly make things happen in our investment accounts regarding our investment returns. Okay, the fourth thing that drives investment returns is simpler than the other things, thank goodness, and that's simply the fees that we're paying. If you're spending, for example, let's say 1.5% on investment activities, either through fund expenses or maybe through a financial advisor, then your returns have to exceed that 1.5% just to break even, just to sort of make up for that. But it's even worse. You're paying those fees with after-tax dollars. So take the amount you're paying in fees and divide it by 1 minus your tax rate to see how much you're really spending in fees. You're spending more than that 1.5%. And this is an important thing to realize, that those earnings, more of your earnings are going to pay for investment fees than most people realize. And those fees directly take away from our investment returns. I did another video with more detail about this, the things that take away from our earnings, that actual earnings that we get when we put money into investments or when we spend money on fees or other things. Make sure you check out that video if you're interested. I'm not saying that all advisory fees or investment fees are bad or unnecessary. I think a lot of investors are better off working with a financial advisor that considers all the factors I'm addressing in this video so that they can focus on making money or even enjoying their life if they've already reached their financial goals. And I have found in working with financial coaching clients that a lot of people are better off selecting a well-chosen financial advisor. I'm just saying it's really important to be aware that the fees eat into the bottom line of investment returns. I've had some financial coaching clients that were paying over 2% a year in fees when they first came to me. So this is extremely high. And the first thing they did was knock 1% off their fees, and that automatically and instantly increased their returns. In my course, How to Retire When You Want and Fund Your Desired Lifestyle, I have an entire module about this. I'll put a link to my program in the description, and I'll try to remember to put it in the comments section as well. Okay, the fifth thing that determines the investment returns you're going to get are the financial markets. The markets as a whole. It's not about picking those 5 winning stocks. It's not about picking that right, maybe fund or ETF. The financial markets are driven by macroeconomic factors, such as interest rates, as well as other factors. It's stepping back away from thinking that investing about choosing those right stocks or those right funds, and realizing that the direction of the markets as a whole have the largest influence on your returns so that you're invested in the right asset class at the right time. Of all the factors that we've discussed that drive your investment returns, you really only have control over 2 of them. And that's kind of frustrating. The first is the asset that you choose to invest in, such as stocks or bonds or real estate, gold, etc. The second factor that you control that affects your investment returns directly is the amount you're spending on investing activities. So keep that in mind and do the best you can with that. Remember, retire certain.